A viewer named Mike left a comment that stopped me cold. He said, "I've got 500 ounces of silver in 100 O's bars. If things go sideways in 2026, who's actually going to buy them from me? My neighbor? The gas station?" Mike, this video is for you, and for everyone else who's been stacking without thinking about the exit. Because here's the truth. Nobody in the silver space wants to say out loud, the form your silver takes matters as much as the silver itself. And in a real liquidity crunch, the wrong format could leave you holding metal you can't move. First, let's talk about junk silver. These are pre-1965 US dimes, quarters, and half dollars. They're 90% silver, have no collector premium, and are valued purely on their melt value. A $1 face value of these coins contains about 0.715 troy ounces of silver. So why do preppers and seasoned stackers love it? The first reason is divisibility. A single mercury dime at today's silver prices is worth about $2.50. That's a real-world transaction size. You can barter it, sell it locally, or use it in a peer-to-peer exchange without anyone needing a scale or an assay. The second reason is recognition. Every coin dealer, every pawn shop, every informed buyer in America knows what a pre-65 quarter is. There's zero authentication friction. And third, their legal history. These were US government-issued currency. That matters, and we'll come back to why in a minute. Now let's talk about 100-ounce bars. These are the efficiency play, the lowest premium over spot, easiest to store per ounce, clean and stackable. But here's where Mike's concern is completely valid. Liquidity at the retail level is terrible. A 100-ounce bar at today's prices is a transaction over $3,000. Your local coin shop might buy it, but they'll lowball you because it ties up their capital. Private buyers are rare. You're essentially limited to major dealers, refiners, or eBay, all of which involve shipping, insurance, and fees. Authentication is also a barrier. Sophisticated buyers will want an assay on a 100-ounce bar from an unknown seller. That costs time and money. Junk silver? No assay needed. The US Mint already did that work back in 1964. Then there's the seizure question. In 1933, Executive Order 6102 required Americans to turn in their gold. It exempted coins with recognized numismatic or collectible value. Silver wasn't seized, but the legal framework for what's exemptable matters. Coins issued as legal tender carry a different legal profile than privately minted bars. That's not paranoia. That's reading the historical precedent correctly. Let's run the numbers quickly, because this is where most stackers get it wrong on both ends. Right now, junk silver trades at roughly 10 to 18% over spot, depending on supply. A 100-ounce bar from a major mint runs 3 to 5% over spot. A 10-ounce bar sits around 5 to 8%. So yes, junk silver costs more to buy in. But look at the sell side. Junk silver holds its premium at resale, especially in tight markets. During COVID, when silver supply dried up, junk bags were trading at 30 to 40% over spot. 100-ounce bars barely moved off spot because the buyer pool shrunk. The premium you pay going in on junk silver is partially recovered going out, especially in stress scenarios, which is exactly when you want to sell. High-weight bars are the opposite. Cheap going in, potentially discounted going out when liquidity matters most. So what's the actual playbook for 2026? Think of your stack in 3 tiers. Tier 1 is junk silver. This is your liquidity layer for peer-to-peer transactions, local sales, and barter scenarios. Aim for at least 20 to 30% of your stack here. Pre-65 dimes and quarters are the most liquid form of silver on the planet at the street level. Tier 2 is 1-ounce and 10-ounce rounds or bars. These are your mid-range selling units. Coin shops will take these all day. They're easy to ship, easy to authenticate, and easy to price. This should be your largest allocation, about 50 to 60% of your stack. And Tier 3 is 100-ounce bars. These are your long-hold, bulk transfer units, great for moving large value to a dealer or refiner when markets are normal. Keep them, but don't rely on them as your exit in a fast-moving or distressed market. Cap this at 20% max. Diversify the form of your silver the same way you diversify assets. One format is a single point of failure. Mike's question wasn't just about bars. It was really asking, have I set myself up to actually use this metal when it counts? Junk silver is slow and boring to stack. 100-ounce bars feel satisfying and efficient, but satisfying to stack and optimal to exit are two completely different things. Build your stack for the scenario you're actually preparing for, not the one that looks best on camera. If you want me to go deeper on the legal portability question, specifically what the 1933 gold seizure precedent means for silver holders today, comment 1933 below. That video will change how you think about what you own. And if you're new here, the link to my full silver stacking guide is right there. Start there before you buy another ounce. See you in the next one.